Hi, all course participants. Welcome to session 3 on accounting equation. And I, Abhishek Sinha, FRM PhD, will take you through this session. So, the session objective is to understand accounting equation and to analyze accounting equation. So, let's begin. Introduction to accounting equation. As it is an equation, we know two things about it. It has two sides, LHS and RHS, left hand side and right hand side. And both sides are equal. Mathematically, both sides are equal. Most important equation in the financial world is what accounting equation is. And everyone knows it, few people understand it. However, the lucky part is it's highly intuitive and commonsensical. So I believe all of you can understand if you just focus in the next few slides that we have for you. All the best. Let's begin. Assets is equal to liability plus owner's equity at the end of the year. This is the accounting equation as the world knows it. This is one of the most important equations and you need to remember this accounting equation. If you have it implanted in your brain, your life will become easy. And I, Abhishek Sinha, will make this work easy for you as we go along. So, do you remember what are these? If you don't, let me tell you. They are loose tools and buildings, and both of them have future benefit. Anything that has future benefit is an asset. So I'm sure you remember what is asset. So you remember the LHS of the equation. Now let's go further. Do you remember the person who invested in the business? For example, Abhishek Pani Puri wala invested in Abhishek Water Balls Private Limited. So he is a shareholder of Abhishek Water Balls Private Limited. He is the owner of the company. This is owner's equity that we are talking about. And then we have the other level liabilities such as debt. For example, I told you last time, debt is something that we take generally when we are not willing to use our own capital or we don't want more shareholders, then we go for debt. But debt is risky because if you don't return the money, your business comes to an end. It's an obligation for the future, so it's a liability. On the other hand, we had also talked about onions and potatoes, and these were liabilities as if someone has not paid the price for these onions and for example, I'm a pani puri wala. I've bought the onions and potatoes. I have not paid the price for the onions and potatoes. So the onions and potatoes are a future obligation here because I have not paid the price. And the people to whom I have to pay the price are known as creditors, so they are obligation. So I have liabilities and owner equity on one slide. So LHS was shown to you earlier. Now I have shown liabilities plus owner's equity. So both the sides of the equation now balance. You have assets and you have these liabilities and owner's equity. So let's start by deep diving. Now we are going to demystify some of the terms we did not spend too much of time on in the last session. The first one that I'm going to talk about is owner's equity. You remember this person? He is the owner. He has invested money in the company. He invests money in two ways. So the company owes him both the money that he's investing. One is his initial contribution, the amount of money that he gave the company to have a stake in the company. For example, I paid 1 lakh to buy 5% of the stake of the company. So that 1 lakh is my initial contribution. Then any profit which he flows back, that is any profit which he does not use for himself but he flows back to the company or gives it to the company, the amount of money that he does not take home, this is also known as retained earnings, and we are going to look at it as we go along. Now the mathematics. Let's understand owner's equity better. So owner's equity 1, what does that mean? It means owner's equity at the end of the year is equal to the owner's equity O. What is that? That is the owner's equity contribution in the beginning of the year plus profit minus dividend. So profit is the amount that is owed to the owner. Dividend is a part of it which he takes home. So this equation is very simple. I contribute something to the business, so that is known as owner's equity O, and then the company earns some profit which is mine now, but I have already taken some money as dividend. So whatever is left in the company, which is also known as retained earnings, is profit minus dividend, and that is added to the owner's equity. Originally that is owner's equity O. Now let's demystify profits. Profit here refers to amount after paying all operating expenses. When I'm running a business, I pay operating expenses. For example, I pay cost of goods sold, and then I pay expenses pertaining to electricity charges, fuel charges, etc., which goes into manufacturing, which might be indirect expenses. Then I pay salaries to my employee. Then I pay advertising costs. I pay other costs related to selling and distributing the product. So all of that is operating expense. I also have to make sure that my packaging is done well. So any cost that goes into the operation of the product is known as operating expense. Any office expense is also operating expense. Any administrative expense is also operating expense. Then I pay some financial cost like interest to debt holders. Financial because I have raised money. Raising money is finance, financing my business, which we have seen in session 1. So when I'm raising my money, which is financing of business, I also have a cost attached to it, which is known as interest to debt holders. I need to pay that. And finally, I need to pay the government. What I pay the government is known as tax. So this is what I have done to get my profit. So this is the profit I am referring. Please don't get confused. There are a lot of definitions of profit that floats around. But to me, what matters as a finance guy is profit available to the investor at this point. I'm looking at the amount that is available to the investor. So that is the profit we are talking about. Now we will demystify dividend. So these are the shareholders. We are going to distribute profit to the shareholders. So basically money is going to fly out of the company to these shareholders. This is what we are doing in distributing profit to shareholders. We are taking money from the company and giving it to the shareholder. Why? Because it is their money. A part of it we will keep to grow the business, but the rest we will give. The rest we will give. Now we will talk about retained earnings. This is again an interesting concept. Retained earnings is equal to profit minus dividend. So the profit is income minus expense, and out of that profit I have paid dividend. What I have not paid is this retained earnings. So retained earnings is left in the company. It is the company's money because they would like to expand the business more. So the shareholder does not take out all his money. He leaves some in the company. That is known as retained earning. Now we will revisit the accounting equation. If you remember, the accounting equation was assets is equal to liabilities plus owner's equity. LHS was asset, RHS was liabilities plus owner's equity. Now what we are doing is we are writing asset is equal to liability plus the contribution in the beginning, which is known as owner's equity, plus income minus expense, which is the profit, and from the profit I am subtracting dividend. So basically I'm calculating the retained earnings. So asset is equal to liability plus owner's equity in the beginning of the year plus retained earnings. I hope this is clear. Let's move. So let's now visit accounting equation for one last time. Here, if you see, what I have done is I have rearranged the components of the accounting equation. I have moved all those which had a negative sign on the RHS, that is expenses and dividend, to the LHS. So now I have asset plus expenses plus dividend is equal to liability plus owner's equity plus income. Now let's observe this equation a little carefully. Let me talk a little more about each of the components. Asset. Asset is a future benefit. But as of now, when I'm purchasing most of the assets, there's a cash outflow. I have to spend money to get an asset. Expenses also, when I incur, there is a cash outflow. Some expenses I might be paying later, but the cash outflow would be eventually be there. Dividend again involves a cash outflow because I'm paying the owner's equity what is his due. So asset plus expenses plus dividend, the LHS side, is all about cash outflow. Now or in the future, eventually there will be a cash outflow because of the three. For most of the expenses and for almost all the assets and for dividend. Now let's move to liabilities, owner's equity and income. Liabilities are future obligations. However, when I am taking a loan, I am getting money into the business. Owner's equity also leads to money flow into the business. Same way, when I earn income, eventually the money will flow into the business. So, if you look carefully, RHS is about cash inflows. So, what I am saying is, whatever my outflows is, some of them might not be in cash, whatever my outflows is, asset plus expenses plus dividend is going to equal to all my inflows. That is equal to liability plus owner's equity plus income. To conclude, I would like to tell you that the LHS is equal to RHS. LHS is all about outflows. RHS is all about inflows. Thank you. Uh, I hope this session was understandable. It's a very important session. It is the basis on which we are going to build our debit and credit concepts in the next session. Hope to meet you soon. All the best.